What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today's panel discussion is on liquidity and its impact on the stock market, and what is the next big macro trade. My guests are Mark Dow. Mark was a policy economist at the U.S. Treasury and the International Monetary Fund fixed income fund manager, hedge fund manager, and manages friends and family money now, and running the Behavioral Macro Twitter channel. It's the Behavioral Macro Twitter channel. And Mark is just great. He's been on the show before, and he doesn't hold back. And I can't wait to hear from him today. And then we also have Macro Elf. He is Alfonso Peccatiello. Elf is the founder and CEO of the Macro Compass, a disruptive investment strategy firm whose mission is to democratize professional macro analysis tools and portfolio strategy. And before launching the Macro Compass, Elf was the head of investments for a $20 billion portfolio for ING Germany. Now, without further ado, let me bring in my guests. Let's bring in Elf, and we'll bring in Mr. Dow here. How are you guys?
Hi, do we do this in Italian, I guess?
Well, I'm the least Italian here. Mark is, I know, always in Italy. You are in Italy. He speaks fluent Italian. I was telling Mark, I said, I lost it, man. I don't have it anymore. I used to know a little bit, and now I'm a full American now.
Buonasera, Mark.
Buonasera, come va?
Perfect Italian, man. No accent. Incredible. This guy knows it.
And so it's great to have the two of you guys here today. I mean, I love you two guys for your commentary, and you guys have really earned my respect over the years, you know, learning a lot from you guys. Everyone pretty much knows kind of where I stand, and I know I'm not a macro guy. I learn from guys like you guys. And the one thing that the two of you do, which I think is special compared to a lot of other macro traders, is you guys put your money where your mouth is, and you guys go out there and actually execute these trades, and you execute these macro ideas. And for today's discussion, you see everybody on Twitter is always an expert, as you guys both know. You guys deal with this all the time. And everybody's talking about liquidity. And I would say this, just even from my standpoint, because like I said, I'm not a macro guy. I know nothing compared to what you guys know. And that's what makes it so interesting for me is to interview guys like you, is what are the impacts that's going to have on the market? Where is this next big, macro trades coming from? And so I think that we just start off with today, Alf, where I just kind of like hand it over to you. I know you put some things together. You do a ton of great work with the Macro Compass, as Mark does with Behavioral Macro, and just kind of have a discussion. I would love to hear you two start getting into it, and me, come in and chirp in a little bit and ask you guys questions about what's really happening right now in the marketplace.
Let's do that. So for me, the first important thing is define what liquidity is. What I hate the most about macro discussions on Twitter or anywhere else is that people just throw words and they don't know exactly what they stand for. So what the hell is liquidity in the first place, right? Removing liquidity from the system. What the hell is that? What does it mean? And so I think what most people really mean is bank reserves. That's what they call liquidity in FinTwit jargon. And what they really care about is whether bank reserves are getting taken off or added to financial markets. So let's define that. And there is no magical model to estimate bank reserves. Bank reserves are one of the items on the liability side of the Federal Reserve balance sheet, together with the Treasury General account, together with reserve repo facility. There is another item which is called bank reserves held at the Federal Reserve. So wherever you feel and see any liquidity model, I'm sorry guys, it's gaslighting. You can just go on the FRED public database and type in bank reserves held at the Federal Reserve, and you will have a magic chart of liquidity all for yourself. Okay, so just debunking a couple of myths before we start. And of course, there is a relationship between refilling the Treasury General account and the amount of bank in the system. But I think before even we get there, we need to define what bank reserves are. What are they for? What is this liquidity that we're talking about? And I'd rather have Mark define what bank reserves are and what bank reserves are for.
Well, so yeah, there are a couple ways. Let me just start by saying, taking a step back and saying, I look at three different types of liquidity. The one that Alf was talking about, which I call systemic liquidity. There's the second one that is market liquidity, bid offer spreads and how deep is the market, that kind of stuff that traders deal with regularly. And then the third is kind of credit or rollover liquidity, right? Which is the willingness for banks to lend. So, and I wrote a piece on this if anybody's interested, called "Misunderstanding Liquidity." I wrote it a while back when people were worried about QT in 2019, and it's a nice review, very short too, just to break it down, precisely for the reason Alpha was mentioning. People say liquidity, but they're not really defining which type of liquidity. And guys talk about market liquidity, and that has nothing to do with the Fed. It's really about the risk appetite of the market maker and what kind of balance sheet he's got behind him, right? And the Fed can increase or decrease reserves in the Fed fund system and have no impact whatsoever, right? You can have high risk appetite and make really tight, deep markets when the Fed is reducing its balance sheet or increasing its balance sheet. It really doesn't matter. So, and that's the first thing. And then, of course, rollover risk is another one that's associated with the risk appetite and not with the Fed. Now, back to the Fed and Fed funds reserves. This is just basically deposits at the Fed that's used for settlement purposes amongst banks. And why it's so important in crisis is because demand for transactions tends to increase. People want to liquidate positions. They want to pay things. They want to reduce things. Money starts moving around a lot more rapidly amongst banks. It's a closed system. So interestingly, these deposits are not fungible, right? I can't have a deposit at the Fed. You guys can't have deposits at the Fed. You have to be a bank, a chartered bank, to do it. So interestingly, it makes treasuries more fungible than bank deposits. Because, excuse me, you might hear cats and dogs in the background. That's kind of life here at the Dow household. Moving around deposits with a greater speed, and that means that they need more liquidity to make sure that at the end of the day, everybody can meet their reserve requirements. Usually, banks need to have a certain amount of high quality liquid assets, which is a combination of treasuries and deposits at the Fed, to meet their obligations, right? To meet their settlement obligations. So the Fed injects this in times of crisis so that everybody can settle their trades or settle their transactions without stressing the system. It also has an effect, a psychological effect. I call it a placebo effect on markets, because people believe that they're injecting it somehow into the stock market or something like that. So it gives people relief. Obviously, it should give us relief that the banking system is not going to crash. But it also gives people relief because they think it supports assets to a greater degree than it actually does. So that's basically how it works. One more thing I want to say about it is reserves aren't needed for bank lending. Banks don't need either, and this is will probably surprise a lot of people. Banks don't need reserves or even deposits to lend, right? Basically, what happens, Anthony, is if I want to lend you money because you want to buy a house, right? I lend you the money, and in the first instance, I give you a deposit in my bank, right? So I create the loan, and then I create the deposit, right? Now you spend that. Now, if you're a business and it's not a mortgage, you might spend it slowly over time because it's working capital, right? And that's how it gets into the system. But as a bank, I've created money, and people and people don't realize this. The banks, chartered banks, have printed much more money than the Fed ever has, right? And this misleads a lot of people in their thinking because they think only the Fed prints money. But the Fed does the same thing in a certain sense when they take a bond from JP Morgan and they give JP Morgan a deposit, right? They're not so they're creating a deposit with JP Morgan, but they're just swapping assets and liabilities. A bank does that when they lend you money in a certain sense. The only difference is when the bank lends you money, it has an economic effect because you take those proceeds and you put them into whatever you're going to do. You buy the house, or you use it for your business, or what have you. When a bank, when the Fed does it, the bank says, "Oh, I used to have high quality liquid assets in the form of treasuries and deposits at the Fed. Now I have a little bit more in deposits and a little bit less in bonds." But it doesn't change it. Doesn't change their asset allocation, right? They still need their high quality liquid assets. So banks don't need deposits or reserves to lend, right? And they need them for prudential requirements, which is where banks are ultimately constrained. But they're not constrained in the first instance by reserves, because if they need more to meet certain requirements, they can borrow them from another bank, right? That's what the Fed funds market is for. So the two shocking things are banks don't need deposits or reserves to lend, and that they printed way more money than the Fed ever has. This is why M2 is misleading, because M2 has the creation from the Fed and the creation from the banks, but only the banks really has an economic impact, as I described earlier. So what you really need to do is not follow M2. It will deceive you. You need to follow credit. You need to see what the net loans being issued by banks, because there's always repayments happening and there are loans being made. And you need to follow the net of that to see what kind of economic effect there is, because typically bank lending is directly associated with economic activity, whereas the Fed swapping bonds for deposits with banks isn't.
I would like to say something. This has probably been the best 8 minutes on the functioning of financial systems that you will ever hear. Let me recap, Deli, before I get back to you, because there have been, I think, 4 important things that Mark has said here, and I agree on all of them. I've nodded for the entire time. The first is, here we're talking about money for banks, bank reserves. This is commonly referred as liquidity, and it's the topic we want to discuss today. Refilling the Treasury General Account, as we will show in certain cases, lowers the amount of bank reserves in the system, commonly referred as liquidity. Bank reserves is money for banks. It's a closed system. This is something extremely important. Banks cannot give reserves to me. Banks don't use reserves to lend. Banks don't multiply reserves. No, guys. Banks just use reserves to pay transactions and settle them against each other. That's all they're for. Transactions against the Fed and transactions against banks. So imagine it as the lubricant of the interbank system. That's what bank reserves are, effectively. It's a closed system. They can't get out. That's the second important thing that Mark said. And the third important thing that Mark said is the amount of reserves in the system, being a closed system and not being able to get out to the real economy, it doesn't mean that these reserves will end up in the stock market. So if reserves are money for banks, you need to ask yourself, what can banks do with these reserves in the financial markets? And here is what they can do. They can lend them against each other in the repo market or in the Fed funds market. They can lend these reserves to each other banks. Remember, it's a closed system. They can't get out. They can just stay in the system. They can settle transactions against each other. So it means if a bank buys a bond from another bank, they can settle the transaction using reserves. As you can see, the equity market isn't really involved because Treasury Department of banks cannot, or it's extremely hard for them to buy stocks. Banks need to own high-quality liquid assets. You've heard the story from the Silicon Valley Bank. I think before you, probably everybody has learned what high-quality liquid assets are. Stocks are not, in 99% of the cases, eligible as a high-quality liquid asset. So that means a bank cannot and will not turn reserves to buy stocks from another bank, because that would be the only way a bank can use reserves. Reserves are money for banks. They just settle transactions against each other, which mostly means they are a mean of lubricating the interbank financial system. That's all. That's all reserves are for. And the Treasury General Account...
Can I throw a point in here to kind of make... This is the bare bones of what you need to know, what alpha standard. That's the basics. Any deviation, so it may well be that if the bank sells a 10-year treasury to Fed and get to deposit, all of a sudden they have a duration shortfall relative to their target that they might have to make up. So they might go out and buy another bond. In some cases, they might buy a mortgage bond, which is a little bit riskier and it doesn't qualify as high quality liquid asset, I don't think. But it's a high quality liquid asset, but it doesn't. I don't think it qualifies. And they could even buy, if they really wanted to, some high grade debt, right? But it's not that common. Most people who are trafficking in bonds, they have a mandate, whether it's a bank treasury or it's PIMCO, right? And they can't go beyond that. And then, your average investor has an asset allocation. So think about it this way. You have your standard asset allocation of 60-40, right? 60% stocks and 40% some combination of bonds and cash. And let's, for simplicity's sake, say that you have T-bills. Your 40% allocation is to T-bills. So if the Fed buys all of your T-bills and gives you a deposit, actually what would happen if you're an individual investor is you sell them through JP Morgan. So JP Morgan would get a deposit from the Fed, and then they would give you a deposit on the other hand. They would offset each other. So you end up, Anthony, in your portfolio, you've got a deposit at JP Morgan who has a corresponding deposit at the Fed. Now, you might turn around and buy Tesla stock with it, or Pepe meme coins, or whatever you want. But that's a different asset. You change your asset allocation, right? It's fundamentally so. You can, if you're an individual who sells bonds that end up at the Fed in a certain sense, you've got your deposit. But to change your asset allocation, you have to make a separate decision about your risk appetite.
Yes.
Right. So in a way, deposits could creep into the system. Let's say you get these deposits because you sold your bonds to JP Morgan, sold them to the Fed. Maybe in a couple of months, you're sitting on T-bills and say they're not yielding a whole lot, and the stock market's going up, or I want to buy some, or I feel left behind, I'm going to buy some high yield bonds. You could, and say I'm going to do a 70-30 allocation, and you nudge it up. That's a way over time that deposits, Fed deposits, could creep into the system a little bit. There is that mechanism, but most people, as I say, are constrained by mandate, and it's a separate decision anyway, where you're saying, I want to increase, my risk appetite is increased, and I want to buy something riskier. So it always comes back, the way for liquidity of any sort, whether it's the market making liquidity, credit liquidity, or systemic liquidity. For any of them to have any impact whatsoever, it requires a change in risk appetite. That's what it comes back to. Anyway, I just wanted to add that point.
Veli, your turn to say something. We have hijacked.
I'm trying to take all this in, Elf. And I tell you what, there's definitely a majority of what you guys talked about are things I had no idea about. I'm writing notes, not necessarily things I'm going to talk about in here right now, but just for my own personal well-being. And I think that, what I see in a lot is, and I guess I'll bring it into really the average trader or an investor, right? And I don't know if maybe we go back to the slides, Elf, if you need to. I even like Jem Kersan. I think we all know who he is. I think you recently did a podcast with Jem too, Elf. And he was talking about the other day, was getting tons of traffic when he was on with Santelli, talking about the liquidity and what's about to potentially happen. You see all these people talk about just getting ready to pull the rug in the middle of summer. I think I'm trying to put context to that for people, because you see so many people follow that, and it's like, and you see all these people retweeting and are talking about it, but I don't think they understand what is. Maybe I don't know if you actually saw that clip of him with Santelli, but what is the fear that everybody has that is going to have this immediate impact on markets?
I think the fear they have is that they've seen a couple of charts going around on Twitter where two lines are drawn against each other. One is bank reserves, often called with some model liquidity thing to make it sound very fancy, but they just plot bank reserves. And the other is the S&P 500 or the NASDAQ or Bitcoin or any risk asset. And look, there is a couple of things to say there. The first is that the Federal Reserve balance sheet over the last 10 years has gone up over time, and the S&P 500 has gone up over time. So by plotting two lines that go up over time in the same chart, they will obviously look nice together, right? Now, I ran a regression, a very simple analysis where I just said, okay, let me see if I can explain the changes in the stock market with the changes in liquidity, often referred to as liquidity, so bank reserves, as we just discussed. And you can explain about 2 to 3% of the entire changes in returns in the stock market only by using reserves. 2 to 3%. The remaining 97% can't be explained by reserves. And that makes sense, Del. If I would tell you, look, I found a magic formula to predict where the stock market's going to do just by using this very single line item, you would think I've gone nuts. But that's unfortunately is that people like easy narratives. They like easy charts. They like easy narratives. What Mark and I are doing here is hopefully trying to explain a bit more in depth the linkages that I can think of that might refer to a drop in bank reserves with a decline in the stock market. That seems to be the narrative out there. It's really hard. I need to be very creative, and I need to think the following. Banks have less bank reserves, and therefore they are less prone to engage in the repo market. They have to absorb more T-bills coming from the government because it needs to rebuild the Treasury General Account. We can look at how mechanically it works on the slides. So as banks are more busy doing that with less reserves in the system, they might, on the margin, take a bit less risk. So buy less mortgage bonds, buy less investment grade credit spreads than they did before when reserves were more abundant and T-bills weren't issued and therefore didn't need to be absorbed. And therefore, because banks are more busy doing that, they might be less busy buying credit product they can buy under their mandate. This should then, assuming this is true, this should then wake up equity investors that see credit products widening because there is less marginal appetite. And therefore, as credit product widen, appetite in equity markets slows down, and therefore you have a sell-off. This is a very creative explanation that I can try to fit into the narrative if I want to, but the reality is the narrative by itself doesn't necessarily hold.
This is what I think people are thinking. I mean, that chain of events is plausible, but it's way too complicated. We live in a world where people hire an intern to summarize the headlines for them because they don't have time to read the whole thing, right? That's kind of how people seem to make decisions. And the way people are thinking about the TGA, rebuilding the TGA, is that there are two different channels through which they think it might have an impact. One is that the Treasury has to issue a bunch of T-bills. That's going to drive up rates, yields, and by driving up yields, that's going to dampen risk appetite. People are going to sell equities, right? That's cost of money goes up, opportunity cost, this all kinds of things. People understand at some level that higher interest rates tends to have a dampening effect on stocks. Not always, and many instances where it doesn't, but that's a mechanism that people intuitively get. The other one is a lot of people, they think about the Fed. They don't think about it as an asset swap. They say they're printing money. They're printing money. They're giving it to people, right? And because they think that, they say, oh, they're going to be taking away that money. They're going to be taking away the reserves that get spent on Tesla or Pepe meme coins or whatever it happens to be. So those are the mechanisms, and both of them are false. Although it's possible that yields go up when they issue a lot of T-bills. It could happen. I doubt it goes up enough to have the kind of effect that these people are positing. And as we've seen lately, higher interest rates has been positively correlated with stocks, or higher yields have been positively correlated with stocks because it means a lower probability of recession, right? But I think those are the mechanisms that people think about when they worry about the TGA having this effect.
Deli, should we bring in the slides so that we can show?
That's what I was going to say. Let's go back to the slides, because I think a couple things I just want to talk to everybody about as well is that with these slides, we need three people. We need Mark in there too. Let's see if we can get him in there. There he is. And it's funny, if you guys want to know about the monkey story, go back and listen to Mark. It was years ago. Remember, Mark? I think that was one of the first questions I asked you on the podcast. I go, man, I've been waiting to talk to you for so long. I go, but I have to ask, why the monkey? And if you want to go back, the monkey with the machine gun. Right?
This is actually the avatar from the Behavioral Macro channel. My other channel, Mark Dow channel, has a monkey holding a machine gun. and old Photoshop from back in the day that I found somewhere. And the thinking behind it is that I was trying to communicate that you don't have to be a genius. You don't have to be the smartest guy in the room to be a good trader. You have to be pretty aggressive. You have to be pretty competitive. But you don't have to be necessarily the deepest thinker. You just have to be aggressive and manage your risk well, right? So I use that as kind of a shorthand, not because I'm a guy who came from a hardcore fundamental backdrop, right? So I have every incentive to play up the fundamental side, but it's really, at the end of the day, Anthony and I always connect on, it's about risk management. But I want to say one more thing though before we get to this slide, that back at just to close that last point. On the that little blog post I wrote about misunderstanding liquidity, I took a little some data in there. So just to illustrate the point, from 1981 to 2006, total credit assets held by U.S. financial institutions, so lending basically, right? It grew from 32. It grew by 32.3 trillion, right? So over that period, it grew by $32 trillion. So 750%. Over that period, how much do you? So a lot of people think, well, they need reserves to lend out, and deposits to lend. How does that happen? So over that same period, reserves, Federal Reserve reserves fell by 6 billion. So basically, they were flat. They were unchanged. So that just shows you that the link between reserves and lending, or reserves and risk taking, is not what people think it is, right? So just to hammer that point home before we get to the slides.
I would be the first to admit that I didn't understand that until you guys explained that to me today. So I mean, I know a lot of people listening. When you're listening to guys like Alpha Mark, I know it can be intimidating, but it's like,
no, it's not.
Yeah. Well, I'm always happy to admit what I don't know and don't understand, and that to me is eye opening. It's like one of those things where you hear it, and you're like trying to think about it. You feel like you've been kind of taught the wrong way from Twitter.
And not just on Twitter. Listen, economics classes were taught. The money multiplier, right? And the loan funding, they're using the kind of the wrong models when they explain these things. And a lot of people, particularly around your neck of the woods, Anthony, in Chicago, Milton Friedman said this, and monetarism, and they have these things drilled into their heads, and they're wrong. But I like to say that if you don't understand that reserves aren't needed to lend, deposits aren't needed to lend by banks, and that banks print way more money, quote unquote, print way more money than the Fed does. If you don't understand that, read until you do, because it's the most important thing that you understand. We're going to have a lot of people that are left behind. They're going to be left behind. I think we're in a bull market. In fact, I thought when I went on last June, I thought with Alf, I thought June was the bottom. We kind of undercut that in October, but basically, I thought that's what was the beginning of the bull market. I still think we're in one, and the people who are looking at M2 declining and looking at the inversion of the yield curve are going to get left behind because they don't understand how this works.
Yes, I agree with Mark on not understanding. I don't think we're in a bull market, but that doesn't matter because that's what makes a market. What makes a market is Mark and I disagreeing on a view, but here instead we're talking about having the weapons to understand how money works. I mean, how are you supposed to be even a macro investor if you don't understand how money works? So Mark is totally right in spending time in this. There are two main misconceptions, I think, Deli. And one is that banks create money when they lend, and they don't need your deposits. They don't need reserves to do that. And the second is that the government prints money when they do deficit spending. Under most of circumstances, every time the government cuts taxes or does deficit spending, it is injecting the same amount of net worth into the private sector. This is something that is also very complicated for people to understand. The flip side of it will be if the government does surpluses and everybody wants to cut government debt, right, Deli? I mean, that's what we hear all over the place. That is too high. It needs to be cut. Yeah. The moment you cut government debt, you are taxing the private sector. You're taking money away from the private sector. That doesn't mean the fiscal deficits are always good, but it means they create net worth for the private sector. It's up to the private sector how they use it, how productive they are with these tax cuts. If you go and
This
you know,
is an
buy
important point.
some...
I'm sorry. This is an important point. I wouldn't call it printing money. They're injecting wealth, because when the Federal Reserve buys bonds, there's no increase in the private sector's net worth. It's unchanged. But what happens, what the Treasury does, is they spend money and then they issue debt, right? So the liquidity in the system is unchanged, but the wealth has increased, because now you have people holding bonds and you have people who have received the payments from the Treasury. So wealth has gone up, right?
So this is what the slide shows here, Mark, in these T accounts. This is before we go into the Treasury General Account refill, I wanted to show to people what happens in the standard circumstance where the government does deficit spending and then it issues bonds, not to refill the TGA, but it issues bonds to actually fund the deficit spending. So that's the standard circumstance, okay? The government issues bonds because they have to fund deficit spending. And if you follow the T account that you can see on the screen, it's really easy to understand that if you start from the government on the left, what the government does as the first operation is what you see in blue. It spends the money. Okay, so this idea where the government needs to borrow to spend, it's the government issues the money, guys. The government issues the very currency we use. The moment they spend the money, they cut your taxes, let's say, straight away, bam, taxes are cut. What you receive, as Mark said, on the household side, so move all the way to the right, is an injection in equity. You literally get more money, right? You have less taxes to pay, you have more net worth, which is reflected on your asset side in bank deposits. So instead of paying more taxes to the government, all of a sudden you have more money on your bank account. Do you have a liability attached to this operation? No, not immediately. The government has literally cut your taxes without asking anything directly back from you. So you don't have a liability. You just have more money, more net worth, more bank deposits.
And they've issued bonds.
Now,
the
obviously,
government has issued bonds to finance it. So, so emission of bonds.
And at this point, indeed, they go into the green. If you have a look at the green part of the T accounts, if you go back to the government, what they do at this point mechanically is that they issue bonds to fund the transaction. Now, unless you as a household are asked to go and buy these very bonds, which is a very rare circumstance, in most cases, it's either the Federal Reserve or it's banks buying the bonds issued by the government. So you are left as a household with more money, literally more net worth that you have at your disposal, while banks and the Federal Reserve take care of absorbing the issuance that is coming from the government to fund the deficit spending.
And even if private individuals buy those bonds, if private individuals buy those bonds, their net worth goes up, even if their cash on hand doesn't. So the wealth still goes up.
That's true. So this is one of the first mind-blowing things, because people believe that deficit spending is evil and that it's taking resources away from the private sector. The reality is that as long as, and most importantly, in general, banks and the Federal Reserve are taking care of absorbing the bond issuance that comes from the government, they want bonds. Banks need bonds. They want bonds. So they are going to be there to buy them. You, as a citizen, only got the plus of it, which is more net worth. Now, this is the operation that happens when the government issues bonds to fund deficit spending. But Deli, if you go to the next slide, now we have a different situation where the government is called to issue T-bills. To be honest, that's what they will do. They will issue T-bills not to spend it in the real economy, but to boost the Treasury General Account. So go back all the way to the left end of this T accounting. And again, guys, read what Marcus has wrote. If you go on the Macro Compass, there is a bunch of free stuff I wrote about the monetary system. Spend time on this, because if you don't understand this, it's hard to trade and to invest, really. And even simple stuff like T accounting. I mean, this is like first year undergraduate economics thing. It's enough as long as you think about the flow of money. So the government here needs to refill the Treasury General Account. You see that in green. On the asset side of the government, TGA. So they need to refill that. To refill that, they're going to be issuing bonds, right? Or T-bills, to be precise. So now the government effectively has to issue the bills. You see on the liability side, they go up by 100. They don't spend this in the real economy. If you go to households on the way to the right, there is nothing happening there. Right, Deli? I mean, you don't receive any money from this operation, nothing. They just issue bonds to refill the Treasury General Account. Now, in this operation, what happens standard is that the Treasury General Account, which sits on the liability side of the Federal Reserve, goes up. And as that goes up, something else on the liability side of the Fed needs to go down, because the Fed isn't printing any reserves. The Fed isn't doing any operation in all of this. It's the government, which is issuing bonds to refill the Treasury General Account. Treasury General Account goes up. The counter mechanism is that reserves move down. Reserves move down also because banks are called as primary dealers to absorb the T-bills which are coming from the government. So the government is issuing these T-bills, and the banks as primary dealers need to absorb it. So reserves is generally so-called liquidity by 90% of FinTwit is the balancing mechanism in here. There is one thing that could stop all of this, by the way, which is the reserve repo facility. So I think I have this example as well. I don't know if you have put up a slide there as well, because there is also, no, not, try the next one. Yeah. And then I'm going to pause because Mark will have stuff to add for sure. There is so this is the standard thing, right? When the government issues money to bring up the TGA, reserves go down as a counter mechanism. Well, there is another item on the liability side of the Federal Reserve which could counterbalance the increase in TGA, which is the reserve repo facility. That's over $2 trillion as we speak. So the idea here is that the mechanism is exactly the same, but banks don't need to absorb and warehouse all the T-bills that are issued by the government, because money market funds will take the money away from the reserve repo facility and buy these T-bills. Money market funds, they want T-bills. It's in their mandate actually to buy T-bills. So as long as the yield on T-bills is attractive enough against what money market funds can make at the reserve repo facility, they will buy the T-bills. When they buy the T-bills, they take the money out of the reserve repo facility, a liability of the Fed, and they absorb the T-bills. So they are the counterbalancing mechanism. They could be the counterbalancing mechanism that could basically offset this operation without reserves, so-called liquidity, taking most of the hit. There are over $2 trillion in there, and I think money market funds will use some of this money to absorb the issuance of Treasury coming in to refill the TGA. So it's much more nuanced than just a one-on-one relationship between the TGA refill and the amount of reserves going down, because money market funds could absorb some of it. And even if bank reserves would take all the hit, Deli, because of what we just discussed with Mark and the importance, the overblown importance of bank reserves by many, I think this is not, you cannot base a bear market hypothesis solely on this liquidity story. This would be my conclusion.
I think that's exactly, you nailed it.
I mean, it makes a lot more sense to me now, for sure.
It's perfect. I would add that the reserves, I mean, first of all, we were arguing that the reserves don't really matter for risk taking, right? The link is so tenuous. It's not zero, but it's so tenuous that it doesn't really drive markets. And we know this because as I've said many times, we just had 500 basis points of hikes in a year, right? And the Fed has almost done it, almost up to $1 trillion now of QT, right? The stock market is higher. Now, if we rolled tape, gone back and projected a year ago and said, okay, what were people predicting? What do you think would happen if the Fed hikes 500 basis points over the next year and takes $1 trillion off the balance sheet? People would not be saying we are where we are, right? Yeah. And we also know that looking back in history, we had a bigger bubble in valuation terms in 2000, and the Fed funds rate was 5, right? The nastiest lending of the global financial crisis, the housing bubble, took place between 2005 and 2007. Those were the nasty vintages of mortgages. Why did they happen? And Fed funds was 5% then too. They happened because people were dropping credit standards. Bubbles always happen when people drop credit standards because they get greedy. It's not about the cost. It's not about the cost of money. I mean, if it's above 10%, then maybe it starts mattering. But if you're within even from 0 to 5, or 0 to 6, maybe 0 to 7, doesn't really matter. If people get greedy enough, they will go. Like I said, you couldn't. How did we get higher valuations in 2000? Right. So Alpha's right. If you're bearish now, you have to have a different mechanism in mind. This is not going to get you right. I kind of said a while back, because I've argued for as long as I've been on Twitter that QE is mostly a placebo effect. In the first instance, it short circuits panics, and it provides the liquidity for the financial system to settle its trades, to calm things down. Right, it's a buffer for that, but it doesn't get pumped in the markets, and people say, "Oh, you're nuts! Look at these lines." The lines Alpha was talking about. You're an idiot. You're and you got all the typical insults you get on Twitter. And I said about a year or so ago, before the Fed started hiking rates, and before they started QT, I said, if in 2003 the market gets to all-time highs and the Fed is still reducing its balance sheet and hasn't cut rates, you have to admit that the theory behind QE driving assets and QT killing assets is wrong. Right. And I think we're getting to that point. Now, maybe we have some kind of recession and we can talk about the risks in the market now, but it's not this. Liquidity comes from risk appetite. Right. Banks create liquidity, as I said earlier. They print money if they want to lend. So, and that comes from having a risk appetite. You can have high risk appetite at 5% of Fed funds rate or 0. Right. I mean, if you remember from 2010 until 2014, 15, basically, no one was taking any risk, and Fed funds was 0. Why? Because they didn't have risk appetite. So it all comes back to risk appetite. And once you get that basic point, everything else kind of falls into place.
So I jotted down some things here. I just want to take a quick moment and pause and remind everybody today's podcast is sponsored by TradeStation. And if you are a serious futures trader and you want a powerful platform, just go to tradestation.com/Anthony. And we also have 50% off your commissions over there at TradeStation. And I want to remind everybody, if you're listening to this later on audio, iTunes, Spotify, or wherever, if you're listening to this today, all of these graphics that you're seeing in here, you can download at anthonycrudele.com. It's in our chart deck. It's free. You can go there and get it anytime. And there's actually even more than just what we're sharing today in there. So it's really important, I think, to put some of this stuff to context where you actually can have it in your hand and read it. And like I said, we'll drop that link in there as well. What I want to talk about is, Mark, I mean, you definitely have been on top of this, where you have said, with the QE and the QT, and how you talked about the placebo effect. I guess I want to look at things now and say, where are the risks then? We see interest rates have been upticking. We talk about all these things, liquidity. I mean, we're hearing obviously what your cases are in that. I want to go back to the slides, but I want to kind of piggyback off of you talking about what you say the risks are now.
The risk is growth. Simply put, the good news is if growth tanks, inflation's going to tank too, probably, reasonably probable. Most of the supply side shock stuff has worked its way through the system, but that's the risk. The reason I'm not as bearish as others, tend to, I'm more sanguine on this, is because 2 reasons. I need to keep it really high level. Everyone and their brother saw higher rates coming. Every CFO on planet Earth saw it coming. People turned out, balance sheets are good to begin with. Household balance, unlike 2008, 2007, private sector balance sheets, both household and corporate, are good, right? And secondly, people saw this coming, so everyone had a chance to refi. If you didn't refi your house in this period, what were you thinking, right? And the CFOs got ready. That means their debt is not only is it relatively low by normal metrics, it's been termed out so that the maturities are kind of, they're stretched out. So as we're going to have a headwind for sure, as everyone rolls over, every year there's going to be debt maturing and people have to refinance to the extent they need to at higher rates. And that's going to be a drag on economic growth. But because we've seen it coming, and because the debt levels are good, private sector balance sheets are good, and it's been termed out, it's going to bleed into the system. So I see it as being a headwind to growth extended over a fairly long period of time, rather than something that's going to provoke some kind, a cliff and a recession. And recessions tend to happen, the way that the deep recessions happen, it's when it's a little bit like a trader, Anthony. You know, if you're heavy into margin and you're got an aggressive position, it doesn't take much for you to close things down. When you get a signal that said, "Oh, my hypothesis is wrong," or it could be wrong, I better shut it down. If you're running a smaller position, right? Maybe you ride it out. You say, "Okay, I'm not deep into margin. I'll give it a little more time," and maybe you'll take it down in pieces. But if you got a lot of risk out there, you take that position down quickly. That's what happened in 2008. Everyone was levered up with a lot of risk, and something happened, and they said, "Oh Jesus, I need to take this. I need to take my risk down." And then you get the cascading deleveraging effect. Well, one guy sells, and then the next guy sells. Price goes down, forcing more people to sell. If it's happening gradually, right, because people aren't as extended, right, they aren't as levered up, then you don't get that cascading effect that tends to produce deeper recessions. And the second point is that, we've been bracing for the past 12 months for imminent recession, right? That's been the call. Well, if you're a CFO, if you haven't been getting ready for it, trimming things, even if you weren't super extended out over your skis in terms of risk, if you had anything hanging out there and there were elements of the economy where they were, right? Think about Silicon Valley and some of the labor hoarding that they were doing in some of the startups. Okay. Well, that stuff gets cut back pretty quickly, but the mainstream companies weren't that extended. So, and they kind of trimmed here and they trimmed there, and they've been doing it for 12 months. And again, if you get caught out by a recession now as a CFO, you're going to get fired, and you should be, right? Because it's been well telegraphed. So I think for those reasons, there's kind of this preemptive de-risking, and we weren't starting at very high levels of risk to begin with from a private sector balance sheet perspective, right? And that people had this termed out debt as well as relatively low. I think the chances are really good that this remains a headwind and doesn't push us into any kind of nasty recession. That makes me more bullish. Also, as a final reason for being bullish, people tend to think, there's an equilibrium multiple for markets. This is 18, 21, 16, and this is where markets clear, and they look back at history. But it's really a supply and demand thing, right? And what have we had over the past 30 years? We've had a huge increase in inequality for a couple of reasons. Get into them if you want, but wealth and income inequality has been growing for 30 years. And what does that mean? It means wealth is going into the hands of people who have a lower marginal propensity to consume, a higher marginal propensity to save. Guess what they're doing? They need to place that in financial assets. And it's created an imbalance, right, of demand and supply. And we solved that a couple of years ago with all these fake assets being produced, coins and meme stocks and stuff like that. And that's how all these things end, right? Assets get invented and to suck up the excess supply, and then things come crashing down. Well, we're back at a point where it's probably more assets, more financial assets to be put to work out there than there are real assets to buy. And this is why, every the peak multiple is at a different level. And I think it's a higher level now for that reason. Second, and there's another point to it, a coda to it, and that is there are a lot more people doing passive investing over the past 15, 20 years than was the case before. So they don't really care about the multiple of Apple. They just have their allocation to it, and it goes to their, RIA, and they have their little asset allocation model, and it goes in. So this increases the equilibrium multiple as well. People are just less sensitive to multiple. Of course, the job of an RIA, unlike stockbroker of yesteryear, puts you into a stock, and RIA today holds your hand so you don't panic and sell in the downturn. That's his job, his or her job, right? So for these reasons, I think people are waiting for the market to clear. They think multiples have to compress. The market is too expensive, and I just don't think that matters so much anymore. What matters is, are we going to have a recession or not? And if we do, how severe is it going to be? And I just kind of explained why I'm on the light side of the slowdown. I think it's a headwind that's going to last for a lot of years, because not all debt comes due immediately. It comes a little bit due each year, and costs will increase, and that will be a headwind. But I don't think it's going to be dramatic. Anyway, it's my
yeah. No, I mean, thank you for explaining that. And it's hard for me to disagree with any of what you said. I mean, Al, if we go back to you, I know that you feel, I think, a little bit differently than Mark and some of the things he discussed. Up to you if you want to comment on that. I know we
Yeah.
still got some slides. I'll go wherever you want.
Yeah. So look, the Mark said a couple of relevant things here. Before we talked about tracking the amount of real economy money creation. So that's credit in our world, right? And I have taken the piss of going to build my own credit impulse metric, which looks at the real economy money creation in China, in the US, in Europe, in the UK, and in Japan. It's inflation adjusted real economy money printing. Okay, so it's how much money we or corporates are getting our hands on through credit creation. And if you look at that index, it does pretty okay to help you understand whether earnings growth is going to be strong or not, whether real economic activity is going to be strong or not. And we explained it before with Mark, it makes sense. The more credit you throw at the economy, the more likely it is that the economy is going to be stronger. It has simply more money to spend, more real economy money to spend. If you stop the pace of credit creation or you slow it down materially, then you get the opposite effect. Things slow down. And look, that metric looks pretty bad right now. And that's because we are all doing the same thing at the same time. In 2020, 2021, everybody was busy doing fiscal stimulus and bank lending and capital market credit lending and all of that stuff, right? All together. We were doing all the same thing. And then from 2022, we have tightened our belt all together. Fiscal deficits have gone down, and then bank lending has gone down on a marginal basis, inflation adjusted especially. So now that index looks pretty bad. And, it's been predicting this turn down in earnings so far relatively well. And now you're having year-on-year earnings about, -3, -4, something along these lines, right? It's not a recession kind of earnings drag. And that has surprised many because most of these models were anticipating a much faster decline in real economic activity. And I think Mark has valid reasons why that hasn't been as fast and as bad as people thought. It's because people have termed out, if you don't print new money, if you don't give new credit to people, but people have a much longer time to breathe it out until they're forced to refinance, until they're forced to, even get more loans for their company, they can wait it out 2 or 3 or 4 years, then it can actually take a while. The economy can remain pretty weak, but you don't have that deleveraging mechanism where everybody's forced to run for the hills right now. Yeah, you don't have that aha moment effectively, but you have a prolonged, weak earnings situation. And that's a bit what I expect. But what people miss a bit when they trade the equity market is that, as a hedge fund friend of mine once told me, Alf, you are not trading a future on GDP growth. There is no future on GDP growth. You're trading the stock market or the bond market or the commodities or FX. Those are not only driven by where earnings print, but they're also driven by inflation, the monetary policy stance relative to where inflationary pressures are. And I think, Deli, that if you look at October last year, Powell was speaking as Volcker, basically. I mean, he was projecting that he was going to keep tightening and tightening. And when people have uncertainty about monetary policy, I think their risk aversion is higher because they don't know where this ends. I mean, maybe Fed funds need to be 6 or 7. And so they don't know. They tend to be more conservative. But from November last year, all the way through today, you can make a case that the impulse of inflation through the economy has diminished. Inflation is not back down to 2%, but it is damn slowing pretty hard. You have outright deflation in goods, basically. You have housing disinflation on the ground, which is happening, and it's going to get reflected in the rent of shelter with a lag because of the calculation methodologies. But rent growth, as calculated really as negotiated on the ground rents, is basically 0 right now in the US. So the housing market has also slowed down. It's going to get projected in CPI as well in the second half of the year. And even the services inflation, from a rate of change perspective, it has slowed down. And when you get that mechanism, unless you get recessionary data right now, then you don't get this deleveraging event. You actually get the certainty back that inflation is going in the right direction, that monetary authorities will not come in with a hammer and you don't know when they're going to stop. They are more predictable than they were or they displayed they would have been in October last year. And the earnings growth projection down is happening, but is happening slower. It's a drag rather than this big deleveraging event that many were waiting for, me included, to be very honest. And I haven't gotten any of that so far. So the combination of the two has made it so that the predictability of the inflation path, and therefore the reaction of Federal Reserve and other central banks, has given more risk appetite back to people, because they don't see the recessionary data now. They have prepared for it, but they don't see it coming. They keep waiting. They only see a weak economy, but nothing more than that. And on top of it, they get inflation slowing down. And so I think they feel more comfortable with taking risks. And I think that's also Mark's idea here. Looking forward, you have to, I think, be a bit balanced here. And I find it also funny to say, well, the S&P is trading at 20x earnings, so that means it can't go higher. Well, in 2007 or in 2000, you have implied earnings yield on the S&P, so the opposite of PE, which was actually lower than risk-free rates. So people were buying stocks at an implied yield, let's say, lower than they could get by buying T-bills. So it's really all about risk sentiment. And inflation, I think, will slow down pretty materially. So I agree with Mark. It's all about growth. If growth grinds down, then you can also grind up in the equity market a bit further from here. If you get the scary event where all of a sudden you get recessionary data, then you're talking about something else. You're talking about an earnings recession. You're talking about people getting more afraid than they are today.
As we bump up on the end of time,
I see it in terms of I see it in terms of an extended headwind as we slowly refinance, but I just don't see the triggers or the preconditions for a sharp turn down. And people keep pushing out the recession, saying, "Oh, it's about to happen. It's going to be bad." And the fact that it hasn't happened now, it's going to make it worse. But I don't think so. I think because people are already taking precautions, it dampens the lag effect. So I feel pretty good about that. Obviously, it's easy to be wrong, and ultimately, being a trader, the mark of a good trader is knowing how to be wrong quickly, and asymmetric payoffs. But I feel pretty good that we can grind forward, and I'm not obsessed with valuations. I think valuations matter in a relative sense across asset classes and within asset classes. People make a lot of decisions on that basis, and I guess that's valid. You look at peg ratios and stuff like that. But as a timing tool, where the market peaks and where the market bottoms, I think it's next to useless for the reasons I mentioned earlier. The supply and demand dynamics are different each time, and of course, as Alf was saying, it's driven by sentiment.
So a few things I want to get to, just because as we're bumping up at the end of time here, and I appreciate both of you taking the time today through our membership site on Anthony Crudele. A lot of questions about AI, NVIDIA, and Apple. I know that we mostly talk about futures here. I mean, any thoughts on just how this is just a boom right now? I mean, is this? You guys feel free to chime in about AI and what we're seeing here in the market.
Mark, you want to say something smart?
No, I don't have anything to say smart about AI. Unlike crypto, it's real. I can say that, but anybody can say that. I was thinking about when Alf was talking about how the earnings yield was lower than treasuries, and I was thinking, now do Bitcoin, right? I mean, crazy things happen when people get greedy enough. Yeah, AI seems like a real thing, and it'll be interesting to see how it plays out. I'm probably gonna start studying a little bit, because I think it's interesting, but I don't know from an investment standpoint. Real quick, in a short-term sense, two things I would say. One, it's kind of extended right now. There's been a lot of enthusiasm, and that probably has to die down. Doesn't mean you fully revert, but it was running hot, and it's got to calm down. But I think at some level there are going to be a lot of people that miss the boat and want to get in. Right. So I don't think it's going to be. I think the valuations are going to be ridiculous on a lot of these things for a while, and then longer term, I think the beneficiaries, because we had this big crash in all the startups, right, and tech, the guys with the big balance sheets, Apples and the Microsofts and those kind of guys, they're going to be the winners, because they get to pick up all the pieces. They're in a position now in an environment. It may not be recessionary, but risk appetite is certainly not at peak. So they're going to be the ones that are able. Sorry about that. Able to throw money. They'll be the ones able to throw money at these kinds of things. Will probably capitalize on some of the leads that they have. I don't know if there's going to be antitrust or whatnot, but I think these guys are well positioned to take advantage of it, longer term.
And so, Elf, maybe we'll go to you. Just the last two questions I'm going to ask you guys is, one is, we didn't talk about really gold at all. And what are your thoughts about gold at this current moment?
Gold is a form of non-interest bearing money. I don't want to call it money because it doesn't have all the properties, but it is often interpreted as an alternative to fiat money and doesn't bear any interest. So the competitor on the other end over there is bearing a 5% risk-free interest rate. It's a tough sell, I think, for gold to start with. And, the reason why gold would perform aggressively from here onwards is probably the reason why people don't necessarily want to hope for, which is, you need to get a recession, you need to get real yields back to zero or negative and all that nice stuff. That's the reason why gold would perform. I mean, you have to go back at 2001, have one of these labor market-driven recession, basically, and then you get the Fed cutting rates to zero in a couple of years because there is a big recession and something bad is happening, and then gold will be doing better than stocks in that environment. Otherwise, you are looking at an asset that doesn't produce dividends and doesn't pay any cash flows against the alternative, even without taking any volatility, any risk, so T-bills, paying you 5%. So it's, apart from the geopolitical reasons where you see China buying more gold and other global central banks that are maybe deciding to reallocate a little bit more of their reserves to gold, that is like a bit of a long-term tailwind. But short-term in this macro cycle, I don't think gold is positioned particularly well unless you expect a recession to hit real fast, real quick.
Yeah, it's actually been one of my favorite shorts lately. Mark, dare I ask you quickly about gold?
Oh, you don't want to ask me. I'm short for sure. I'm not always short, but I shorted a lot. I think right now is an appropriate. It's a trend broke a while back, and it's I posted on, I kind of post what I do, a lot of what I do on behavioral macro, so people see kind of what I'm thinking and what I'm doing. I'm short GDX and I'm short some gold futures. And I agree with Alf's thinking entirely. It had a run up, but what the additional thing I will point out is this is a lot like the cycle in 2010. So people said, "Oh, the Fed's printing money; we need to buy gold." There was a fair amount of that, and then it persisted even when the Fed kind of backed off from it because it had momentum to it. And we heard the same stories about central banks buying, right? So and that fed it. I remember if you go back and look at some of the Twitter wars I had in 2013 with the gold bugs, it was an amazing year for me because I was max short gold and silver. It was probably one of my best trades ever, and it's wild. But all the hedge funds had bought it. I remember telling someone, John Paulson bought gold and he's $1 billion. Do you have $1 billion? So everyone was on that train, and then it unwound. And a lot of that, we've seen a lot of those same stories this time. Oh, they're buying and they're buying and they're doing that. Russia was buying ahead of. I think this had a lot of momentum and made the gold rally last longer, and it went against the movement in rates unusually, and it did a couple of other things that were unusual because Russia wanted to diversify as much as they could away from dollars ahead of invading Ukraine. We know this now, and so that led to people pumping up that story about, oh, look, central banks are buying, and of course, after when the war hit and they saw the sanctions people put on Russia, that led to more central bank buying, right? And so that fed that story. That story just broke. Basically, the momentum from that story a month or two ago, whatever the exact date was, just broke. So from a trading standpoint, that's what got me interested in shorting it more aggressively. So I'm only short two things right now. I'm pretty bullish, as you guys can guess, and that's my biggest short.
Yeah. Last thing, we talked about what is the next big macro trade. I talked about this on Twitter coming in, Elf. final thoughts before we let you go. What is the next big macro trade out there?
I think that if you give me a year and I can spend some premium and I can park it somewhere and forget about it and then figure out if that blew up to be a 5x trade in a year from now, then I would tell you that you can try and buy something that effectively goes for the Fed to cut rates below 2% in a year. So the thing is, either you grind here and you get this, slow headwinds, and then basically it takes a while and nothing happens, and the Fed maybe cut rates because inflation is back to 3%, and then the Fed cuts to 4 or 3.5, which is roughly what the market is pricing.
Yeah.
Or alternatively, you get a much more convex reaction because something has gone wrong, in other words. Now, these options were much cheaper before the banking crisis, so I hope that somebody has bought them up, because now there is a post-trauma stress kind of disorder out there where these bond calls are still pretty expensive. But I think if you want something very convex here, then you can, at these levels today, put it in the box and see in a year if you made the lotto tickets are winning or not.
Mark, same question to you.
I'd be selling that option probably.
There you go.
But I mean, that's how it goes, right? I mean, I just don't think we're going to get anything sharp enough for that to be in the money. But obviously, it's a legitimate view. I would buy equities simply, and I would buy the equities that have lagged. The broadening out trade, I would stick with that. Now, I'm not going to be here to tell you what to do when I'm wrong, right? Because it's easy to be wrong on these things, and this isn't an option.
Sure.
You have to manage your risk, and as we've said 100 times, it's way more important to manage your risk well than it is to have the best ideas. Sexy though ideas are, but I just think I think it's over. I think we're gonna have headwinds, so it might not be spectacular, and it will be a while before anything becomes super bubblicious, because the typical risk cycle, we get way out over our skis and too greedy, then it gets killed, and then it takes us a while to rebuild slowly that risk appetite, because risk appetite doesn't come from the price of money. It comes from two things: feeling relatively secure in your financial situation and looking and seeing people around you make money, right? It's that old quote from JP Morgan that I like, where it's something like, nothing so undermines a man's financial responsibility is seeing his neighbor get rich, something along those lines. And that's how it works, right? That my neighbor's an idiot. He owns 3 houses. I can own 5, right? And make more money. That, he owns Bitcoin. I own, I'm going to buy meme coin. So that's how these mechanisms work. And it typically takes a while for that to build back up after you've gotten your hand burnt on the stove. So yeah, that's so you got to manage your risk. And but I'm bullish equities, and I would go with the things that, like right now, I like home builders. I've liked them for a long time because of the structural shortage and the demographics. I knew it wasn't a Fed bubble, that people had trauma, PTSD from the last time, so they thought it was going to be a Fed bubble, and it isn't. And I like the regional banks. After I stepped in and got involved in those. Those are probably my biggest exposures. And short gold, and I like mortgage REITs. I like the mortgage REITs a lot, the government mortgage REITs, because it's not credit risk, and I think the spreads are historically wide, and the yield really attractive, and the spreads will come in probably slowly, because we're kind of at the beginning. Banks won't be in a position to take a lot of this stuff down, and the Fed is not buying anymore either. But over time, they're going to grind lower. So those would be the things, the themes I like.
Guys, what can I say? We laughed, we learned, and it was just really great to being able to get a chance to speak to both of you guys together. It was just awesome. Remember, everybody, follow Mark on Twitter at Mark_Dow, also behavioralmacro.com, and then for Elf, it's at MacroElf, and he is the macrocompass.com. Both of these guys are great. They lay it out there. It was a great discussion. Guys, I can't thank you enough. I mean, I think we have to do this again. I mean, this was awesome.
Sure, Deli. Next time in Italian, though. Then I'm in again.
Yeah. We got Mark off the beach. I know Mark's on the West Coast. I mean, we got such a massive time change. I think, if you're 6 hours ahead and Mark is 3 hours behind,
Yeah,
we got
exactly.
a 9-hour swing, and Mark's going to go to the beach, and Elf is going to go have a martini, I think.
That's very true. See you guys. It's been a pleasure.
All right, everybody. I'll see you.
guys.
Everybody, thank you so much for tuning in. Hit the
Thanks,
like
guys.
and subscribe button, and please reshare this if you guys enjoyed it. Thank you guys so much. I'll see you guys next week.
Ciao, guys.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.